operates with a lag. So that did feed into the demand side. And again, unions were a little stronger then than they are today. But even in non-union shops, I know I was just at the start of my career. And when that inflation really took off in 77, 78, and 79, then it was going up 9%, 10%, 11%. It peaked around almost 15%. It was well over 13%. I remember in 1981, you could have bought a 30-year US Treasury bond that, with a 15% coupon. Imagine buying that in 1981 and sitting back till 2011, 30 years later, collecting 15% all the time. Well, you could have bought that bond at the time, but people were running away from it because they didn't know how high inflation was going to go. But that was the case where it started on the supply side and morphed into the demand side. So that's exactly what happened. But the bridge, if you will, from supply side to demand side, what was that bridge? Or what was that channel whereby that happened? The answer was, it was accommodated monetary policy by Arthur Burns. And then we had a Fed chairman, G. William Miller, possibly the worst and least memorable Fed chairman in the history. But Burns, much better known, more highly regarded, but he also blundered. But they just put the pedal to the metal in terms of money supply, and the result was predictable. Now, is that a possibility? Yes, but is it actually happening? It appears not to be the case, mainly because the Fed has taken a different approach. I mean, they do. The history of the Fed since 1913 has been one long series of blunders, but they kind of at least know how to fight the last war, even if not the next one. And Jay Powell's looked at this and says, I don't want to be the Arthur Burns of my generation. I don't want to be that guy. And so we're going to snuff out and flush it. It caught us by surprise. We have Jay Powell giving some testimony before Congress in November 2021. It's on the record. We have the video. And he says, I think it's time to retire the word transitory. So he admitted it, threw in the towel, said it's not transitory. Now he's determined to get rid of it. And the Fed started raising interest rates in March 2022. They've got them up to 4.5% in still less than a year. It's only 10 months, or a little over 10 months since they started. So to go from 0 to 4.5 in 10 months is extraordinary. This is not the sky-high numbers you heard about with Volcker in 1980, but in terms of from point A to point B, that is the steepest, fastest interest rate hike increase in the history of the Fed, including what Volcker did. Volcker went much higher, but it took him several years to do it. And Powell's made it clear in a series of speeches starting in August 26, 2022 at Jackson Hole. I won't recite every day, but there have been 5 speeches since then, either press conferences following Fed announcements or speeches, one at the Brookings Institution, for example. And he said the same thing every time. Killing inflation is job one. That's what we're all about. That is our job. We know there's going to be a recession. We know unemployment is going to go up. We know there's going to be pain. He actually used the word pain, which is extraordinary for a Fed chair. But he's made it clear that they're not going to rest until inflation is back to their target, which is 2%. And it's nowhere near that right now. Coming down? Yes, but not there yet. And a lot more work to do. That's what they say. We have more work to do. The markets have kind of taken a very skeptical view of that. The markets, we all see the same data. You can analyze it differently, but we all see the same data. Everyone sees the inflation coming down. But the thing you have to sort out is inflation coming down because the Fed is hiking rates? In which case it suggests you should keep hiking rates until it gets to where you want. Or is inflation coming down because the Fed has hit something called the terminal rate? Sounds like Arnold Schwarzenegger movie. But the terminal rate, no one knows what it is, by the way. I don't know. But now that is Jay Powell, and he admits it. But in theory, the terminal rate is a rate, a policy rate set by the central bank. That's high enough so that if you leave it there, inflation comes down on its own without the need for further rate hikes. So inflation is coming down, no question. But is it because the Fed has continued to raise rates? Or is it because the Fed has hit a terminal rate and all they have to do is nothing? Just pause, as they put it. And inflation will come down where they want. The market believes we're at the terminal rate. The Fed should just stop right now, leave it alone, sooner than later, pivot to, that's the new buzzword, pivot to rate cuts. And it's the anticipation of those rate cuts that has Wall Street all spun up, and they got the pom-poms out and saying, buy stocks, buy tech, because the Fed's going to cut rates. Fed does not see it that way at all. The Fed says, yeah, we're raising rates. Inflation is coming down, but we're not at the terminal rate. We'll kind of know when we see it. But they think it's probably 5.25. That's a very good estimate based on what the Fed has said themselves. I think that's what they know. In this game, you can't do your analysis based on what you think, at least is the first approximation. You have to figure out what the other guy's thinking. It's like chess. Figure out what he's thinking, then do the analysis, and then add your own kind of top spin on that. So there's no doubt that the Fed thinks they've got to go to 5.25. Well, if we're at 4.5, you need 75 basis points of hikes. And it looks like, and we already know on February 1, the Fed is going to raise interest rates 25 basis points. There was some debate about whether it's going to be 50 or 25. They have their channels. You have to know who their favorite reporters are, but we do, and follow those reporters. And if Jay Powell wants to leak something to the market, it's this reporter, this publication. And when you see his name on the byline, you know it's coming straight from the Jay Powell. So the Fed has leaked the fact that the February 1 rate hike is going to be 25 basis points. Okay, so that gets you to 4.75. But take what I just said. If 5.25 is the target, and you go 25 basis points, you need 2 more 25 basis points hikes to get to 5.25. And they will be on March 22, which is the meeting following the one coming up. And then finally, there'll be another meeting in May, and look for 25 basis points in May. We'll fine-tune that. That's still pretty far off, but that would be the best estimate as of now, and that would get you to 5.25. At that point, the Fed might pause. Not pivot, but pause. See to it that inflation comes down. Let's observe the data and watch it come down. Then when it gets to the target, then maybe wait a little bit longer, and then only then would they be ready to cut rates, in their view. Now the market thinks, sorry, Fed, you're already at the terminal rate. You're just the last to know. Inflation is coming down on its own. You don't need further rate hikes. Oh, by the way, you're destroying demand, pushing the economy into recession. Unemployment is going to go up, etc. So the market says the Fed's going to get that memo very soon, meaning February or March. Maybe they'll raise rates in March, but they'll stop there, start the pause, and maybe pivot, meaning rate cut as early as May. I don't see that at all. I understand the analysis, but to me, that's the markets. They call it the Goldilocks or the soft landing scenario. Pick your name. But they're saying that the Fed will pivot before that much damage is done. When they do, they'll cut rates, and that's good for stocks. So buy stocks. That's the Wall Street mantra. My own view is